Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trout, TPSU, and 401k TV. I review all of last week's stories and select the 5 most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, in a surprising move, the DOL decided not to appeal a Florida court decision negating their fiduciary rule, which makes an IRA rollover a fiduciary decision even if the recommendation was not part of an ongoing relationship, one of the key pieces of the 5-part fiduciary test. Rather than changing course, experts believe that the Biden DOL will propose a new fiduciary rule, which will likely take over a year to be implemented and could be quickly reversed if Republicans win the White House. People are questioning whether the majority of the estimated $500 billion that leaves DC plans annually for IRAs are in the best interest of investors rather than leaving the money in the plan or consolidating accounts, especially as more plan sponsors are eager or willing to retain assets and the industry is feverishly developing new in-plan retirement income solutions. Next story, in a rather lightly reported but important story, Gallagher, an integrated insurance and benefits company valued at $41 billion, has acquired Buck Consultants for a reported $660 million. Buck has a greater presence in the DB market than Gallagher, focused on larger employers, and is bigger in the UK and Canada while offering integrated HR benefits and communication services that have increased in importance during the war for talent, with companies looking to increase employee engagement. With the acquisition, Gallagher is taking a different route than other RPA aggregators by going upmarket and focusing on the DB, international, and benefits markets. Lockton, most like Gallagher, decided to exit the retirement market, selling to one of the largest RIA aggregators, Creative Planning, while others like CapTrust, One Digital, Hub, Marshmac, and SageView are focusing on wealth and acquiring RIA firms. Next story, in a move that sent shockwaves throughout the RPA industry, Vince Giovinazzo and Dick Della Vedova resigned their positions as CEO and president of NFP Retirement to focus on FlexPath and RPAG. As RPAs struggle to maintain plan-level fees, shifting to wealth services to participants in their plans, which most have not been able to do effectively, the leaders at NFP saw greater opportunities to oversee and create investment products, becoming a de facto consultant distributor for DCIOs. Madison Dearborn, a large PE firm which owns NFP and by extension pieces of FlexPath and RPAG, recently purchased Wilmington Trust CIT business, now called Great Gray, which has been a big FlexPath partner. No doubt the pending lawsuit against FlexPath had some bearing on the decision to separate from NFP, but so also the desire to expand FlexPath's distribution. Though it will be interesting to see if other aggregators would be willing to work with former competitors, even if they now wear slightly different uniforms. Next story, Aquiline recently led a $95 million Series E round investing in Smart, a UK-based pool provider, on the heels of a $280 million round a couple of years ago. Aquiline had invested in Ascensus and the parent of Plan Sponsor magazine, and more recently, Sageview. Smart had tried to become a fintech record keeper in the US, competing against the likes of Guideline, Vestwell, and Human Interest, leveraging the expected surge in pooled plans like PAPS. But after limited success, they changed course, buying Stadion to focus on managed accounts. And the managed accounts, though growing in popularity and interest in DC plans, is under pricing pressures and is dominated by Morningstar and Edelman Financial, with Goldman buying Next Capital, the next largest provider. Will Smart be able to pivot from a fintech pool record keeper to a managed account provider, likely offering significant price reductions, especially with more money in their arsenal to buy market share? Finally, as the explosion of small and startup plans begins due to state mandates and tax credits in Secure 2.0, as well as group plans like PAPS, Envestnet is making a big bet that their 110,000 wealth advisor clients, as well as RIAs and broker-dealers, will start to work with clients that also have 401k plans. In a video interview with RPA Edge, Sean Murray, Envestnet's head of retirement, describes not just the opportunities, but also the risks for wealth advisors that ignore the DC market, while CEO and co-founder Bill Krager explains why his firm is doubling down on the DC market. Also, Danny Fava, the head of product and innovation at Envestnet, and chimes in on why DC tech development has been so underwhelming and what wealth tech trends she sees most likely to migrate into 401k plans. So those are the most important and interesting stories from the last week. I listed a few others I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking with you next week on 401k Real Talk.